Well, hello everyone. Welcome to our Chapter 9 video lecture. The focus is on flexible budgets and performance analysis. We're going to look at what we call a performance report, in which we're going to compare the actual results against the budget results. Determine if there are variances, difference between actual numbers compared to budgeted. We're going to analyze those variances. Were they favorable or were they unfavorable? So those variances are going to raise questions for us. We want to identify what are the root causes of those variances. Are we spending too much money on material, too much on labor, overhead costs? Once we identify the root causes, we're going to take actions to try and eliminate any type of unfavorable variances and then conduct the next period's operations. So we're taking a look at how to prepare what we call a planning budget and a flexible budget with one cost driver. Let's discuss this term, a planning budget. A planning budget is a budget prepared for a single planned level of activity. So when you have a planning budget, we're going to say that we expect to produce maybe 100,000 units. So that entire budget is based on producing 100,000 units. Now, performance evaluation can be difficult when the actual activity differs from that planned level of activity. So our budget was produced based upon producing 100,000 units. But what if we only produce 75,000 units? What impact does this have on our particular budget? So with a flexible budget, it's going to give us more flexibility, okay? We're preparing a budget for any activity level within a certain range, what we call a relevant range, not just a hard stop number, but we'll say the range may be from 75,000 to 100,000 units. We'll show the actual cost that should have been incurred at the actual level of activity. Therefore, we're comparing apples to apples. So we're saying, well, if we produced 50,000 units based upon the budget, that should have been a cost for producing those 50,000 units. The flexible budget helps managers control costs and to improve performance evaluation. So we have a sample company called Larry's Lawn Service. We're going to prepare a flexible budget for Larry's Lawn Service. So you ready? You excited? Let's get started. Alrighty. So we have Larry's Lawn Service provides lawn care in a planned community where all lawns are approximately the same size. I know that's not going to be the case in real life, but hey, this is academic. We can make up our own scenarios, right? So in this example, all lawns are going to be the same size. At the end of May, he prepared his June budget based upon mowing 500 lawns. Now, since all the lawns are similar size, Larry felt that the number of lawns mowed in a month would be the best way to measure overall activity. So remember we said we're going to have one cost driver. So for this illustration, the cost driver will be the number of lawns that Larry is going to mow within the month of May. Okay? So what we've done is prepare for Larry what we call a planning budget. And we have formulas. All right? Let's first take a look at the revenue side and the cost information. So the cost or the revenue we're going to earn is going to be $75 per lawn that is cut. So the revenue is going to be $75 per lawn that is cut. Q equals the number of lawns we're going to cut within the actual month. Then we have our expenses. We have a salary of $5,000, that's Larry's salary, plus $30 for each lawn that's going to be cut. So when Larry hires his workers, they're going to earn $30 per lawn that they cut. Then we have gasoline supplies, equipment maintenance. These are also going to be variable costs. These amounts are based upon the number of lawns that we cut within the month. Next, we have some fixed costs. So our office and shop utilities are not contingent upon how many lawns we cut. They're fixed at $1,000. Our rent is fixed at $2,000. Depreciation at $2,500. Insurance at $1,000. So now here we have a formula. So if we cut 500 lawns, Q will equal 500. But if I only cut 475 lawns, I'll use these same numbers times 475 to get my actual numbers. Now, based upon cutting 500 lawns, this shows the total expected revenue. This shows the total expected expenditures, and therefore we have an expected profit, not operating income, to be earned in the amount of $5,000. Okay? Now, let's take a look at the actual income statement for the month of June. So we actually cut 550 lawns. This is showing the actual revenue that was earned for the month of June, and these are the actual expenses that took place during the month of June. So we had a net operating income of $6,450. So now we want to compare the actual results against our planning budget. So let's compare the actual results against our planning budget, look at the different variances. So first we look at the number of lawns cut. We plan to cut 500, but we ended up cutting 550. So of course we earned more revenue than was planned. That gave us a favorable variance. So we're saying based upon the number of lawns cut according to plan, we had a favorable variance in the amount of $5,500. Next, we look at our wages and salaries. The actual results was $23,500. Now, based upon our planning budget, that cost should have been $20,000. How would you get that number? Well, you will multiply the number of lawns cut, which in this case were 550 lawns. I'm getting out my calculator. Give me a second. Get yours out too. You ready? All right. So if you multiply 550 lawns and multiply that times $30, I'm sorry, we're looking at our planned budget. The cost was going to be $20,000. That was 500 lawns at $30, which is $15,000, plus the $5,000 salary. The actual salary spent was $23,500. They gave us an unfavorable variance in terms of wage and salaries. But we're actually okay with that. And that's because we actually cut more lawns than what was expected. And we'll take a look to see how it's showing unfavorable right now, but really we'll see if that's really unfavorable or not. We then compare the gasoline supplies costs actual against budgeted. Now, keep in mind that the actual results are based upon 550 yards, where the planning budget is based upon 500 yards. The equipment maintenance cost was favorable. We actually spent less than what was expected. Office shop utility was actual favorable as well. We spent a little bit less than expected. These costs are fixed, except for, well, the insurance is fixed, but the insurance costs end up being $1,200, and we thought it would be $1,000. So we do have an unfavorable variance in the insurance. So overall, from the expenses, it's unfavorable by $4,050. But in totality, we have revenue favorable of 5,500, expenses unfavorable 4,050. When you subtract those from each other, it gives a favorable net operating income in the amount of $1,450. So with this particular budget, it's a planning budget where we're comparing the actual numbers against a planning budget for 500 units. Now we're going to change things up a little bit, and we're going to take a look at what's called a flexible budget. Because see, the budget that we are comparing was based upon 500 yards being cut. But we ended up cutting 550 yards. So we need to do what we call a flexible budget to compare to the actual to see if we really have favorable or unfavorable variances. So the question is, how much of the cost variances are due to higher activity and how much are due to cost control? So again, we know that we cut more yards than expected. So do we have unfavorable variances because of that? Well, let's see. So for a flex budget, we need to know the total variable cost change in direct proportion to change in activity. So again, total variable cost change in proportion to change in activity. Our total fixed cost remains unchanged within a relevant range. So what we're saying here is that if we cut maybe between 500 to 700 yards a month, then our fixed cost will stay consistent within a relevant range. Okay, so let's prepare a flexible budget for Larry's lawn service. You ready? You sure? I'm sure you are, but we're going to pause here and we're going to come back with a second video and prepare our flexible budget. Did I tease you? I'm sorry. No, I'm not. See you soon. Bye.